Hello everybody, and my name is Jill Ford and I'm pleased to welcome you to today's media briefing on the December quarterly review. With me today are Claudio Borio, Head of the Monetary and Economic Department, and Hyun Shin, Special Economic Advisor and Head of Research, as well as the authors of the special features. Before we begin, I'd like to reiterate that the comments from Mr. Shin and Mr. Borio are on the record, and any author comments are off the record, not for quoting or attribution. So with that, we'll hand over to introductory remarks by Claudio. The floor is yours.
Well, thank you, Jill, and welcome everyone. Financial markets shrugged off uncertainties and pulled ahead in the review period, despite lingering risks and an increasing warning signs, notably about the fiscal outlook. Several factors boosted risk sentiment. Positive signals about economic growth, the conclusive election results in the United States, gradual policy normalization in Japan, and stimulus announcements in China. Gains on risk assets offset the tightening effect on global financial conditions of rising government bond yields and of a stronger US dollar. Credit spreads again touched lows last seen before the great financial crisis, and stock prices rose further, in some cases to record highs. In many markets, risk assets appear richly priced. Divergence across major markets grew again after a brief interlude from June to August 2024. In the US, government bond yields surged, especially at the long end, despite policy rate cuts. In Europe and other regions, they rose less. The divergence reflects differences in economic and hence monetary policy outlooks. It could recreate the conditions under which leveraged risk-taking and carry trades thrive. So far, somewhat higher volatility in FX markets appears to have kept leveraged positions in check, but volatility could subside. These developments warrant monitoring, a lesson highlighted last August when the unwinding of the yen carry trade triggered market wobbles. The fiscal outlook across the globe remains acutely worrying and has been increasingly reflected in the markets. We have seen emerging signs of market participants' growing discomfort with the need to absorb the burgeoning supply of public debt. Term premia in core bond markets have risen. Spreads for some euro area sovereigns have widened. As examined in detail in one box in the overview, swap spreads unusually are now negative in all core markets, meaning that the government bond yield is higher than the interest rate on the swap of the same maturity. And repo rates based on government bonds as collateral have also been edging up. Dealers, whose intermediation is crucial for fixed income markets to function smoothly, are rightly requiring greater compensation to absorb the debt as it weighs on their balance sheets. As we have stressed repeatedly in our publications, government debt trajectories represent the most serious threat to macroeconomic and financial stability longer term. At some point, and we cannot tell when, financial markets will no doubt pay even more attention unless authorities correct the course. One additional box examines the greater dispersion of views on the so-called terminal rate, that is, the policy rate seen as the ultimate destination of the current monetary policy cycle. The greater dispersion reflects higher uncertainty that professional forecasters and policymakers are facing at the current juncture. And now, let me turn to Hyun.
Thank you, Claudio. The special features in this quarterly review cover a range of topics. The first feature explores how central banks respond to different types of inflation. Boris Hoffman, Christina Maner, and Benoit Moujon show that central banks react more strongly to demand-driven inflation than to supply-driven inflation. This finding shows that central bank practice aligns well with both the doctrine that they have laid out for implementing inflation targeting as well as the economic theory in this area. Both the doctrine and the theory prescribe a stronger response to demand-driven inflation than to supply-driven inflation, as long as inflation expectations remain firmly anchored. Next, Byung-Chun Kwon, Taejin Park, Fernando Perez Cruz, and Purichai Rungcharoen Kitkul provide a primer for economists on the use of large language models. Large language models excel at imposing mathematical structure on unstructured data so that powerful data processing methods can be used to uncover patterns in the data. LLMs have a wide range of applications in economics, including nowcasting and forecasting economic time series, as well as in natural language processing. LLMs are powerful tools, but getting the best out of the methods needs careful planning and good research design. The authors provide a step-by-step guide for economists, including on data preparation, signal extraction, quantitative analysis, and outcome evaluation. And to showcase the tools, they show a use case where over 60,000 news articles are used as an input to identify key US stock market drivers. Ryan Banerjee, Dennis Guerrero, Denise Egan, and Gabo Pinto examine how the housing supply response to monetary policy is a key determinant of how monetary policy transmits to the broader economy. And they chart some salient long-term trends. For instance, the responsiveness of new housing supply to house prices, in short, the housing supply elasticity, has declined since the 1970s. One key implication is that house prices react more to interest rate changes than rents do. Larger house price responses due to a declining supply elasticity could make monetary transmission more potent via its effect on homeowners' balance sheets. Finally, Brian Hardy, Patrick Maguire, and Gert von Peter continue our special series on international finance through the lens of BIS statistics by laying out the various models of banks' global operations. Some banks operate a centralized business model with key funding and lending decisions directed from the center, while others operate through largely standalone subsidiaries that raise local deposit funding. The authors explain how banks' organizational structures arose from historical changes in the banking sector through consolidation through consolidations, sometimes after major financial crises. The banking models also have financial stability implications. For example, during the 2007-08 financial crisis, banks with standalone subsidiaries, which finance their operations mainly through local deposits, were less affected by funding market disruptions. The authors provide a useful taxonomy of the different banking models and document their respective strengths and weaknesses along key dimensions.
Thank you very much. Now we open to questions. And as we said, we take questions first on the overview and then afterwards on the features. So if you want to raise your hand, please do so, or put your question in the chat. And then we'd ask if you could turn your camera on when asking a question. So given that Bastien Benrath has his camera on already, we'll start with the first question from Bastien. Thank you, Bastien.
Hi, thank you, Jill. Thank you for taking my question. I have one question on the overview and one on a special feature, so I'll hold back with the second one, hoping that I'll get another turn. My question on the overview is, Claudio, you have obviously consistently warned of the unsustainability of government debt levels. And I remember you saying that like things look fine until suddenly they no longer do. So my question is what we're seeing on government bond markets right now, the developments you describe, are those the first signs of things not working anymore?
Claudio?
Well, thank you. Thank you for the question. There are signs that, as I mentioned, financial markets are beginning to realize that their they will have to absorb these growing volumes of government debt. And from this perspective, it's good that markets are reacting. The worst thing that could happen is that they don't react at all until they suddenly change. Now, of course, we are not markets. We look at the markets, and our role is precisely to warn of the risks in advance, because it takes time for policymakers to adjust policies. And if they wait for markets to wake up, it's going to be too late.
Thank you very much, Claudio. And I see a question coming in the chat from Naomi Rovnik of Reuters. Do you think the liquidity and leverage stresses seen in markets this summer could be repeated next year? And how significant is this risk? So Claudio again, I think.
Yeah, it's difficult to say how significant the risk is. Clearly, the underlying conditions are evolving in a direction in which that risk could grow over time, as we say in the overview. Let's not forget, and we said that, I said that last time that we met following the turmoil, tremors, whichever way you want to describe it, in August, that this is the way that markets operate. So that we should not be surprised if in the future we're going to see more of these episodes, because they will happen. The only question is how intense and how often they will.
Hyun, you want to come in on that?
Yeah, just one point to add on this question. I think the thing to bear in mind is that there are various amplification mechanisms that could kick in. We saw that in the August episode, and so one of the reasons why financial markets can turn very sharply, in from one direction to the other, is that these amplification mechanisms, really kick in, and they do so, pretty much at the same time, because there are these spillover effects, and one of the key reasons why, there are these amplification mechanisms is that leverage is certainly one of the routes where you can generate these amplifications, because if you're leveraged, rather than cushioning the price change, you could actually end up amplifying the price change, and that, of course, kicks in both directions.
According to the hands going up, I think Tim Wallace is next from the Daily Telegraph, please. Tim?
Thanks very much. Can I ask a bit more about government debts? Claudio, you mentioned if governments wait for markets to wake up, then it'll be too late. Can you explain what waking up looks like, what too late looks like? Is it a Liz Truss moments everywhere? And also, can I ask more specifically about a couple of countries? Markets don't seem too worried about the US borrowing a lot. Is that a potential problem? And can you expand a little bit on what the report says on France? Obviously, the government there has had a lot of bother with its fiscal situation. Are markets feeding into that? Is there a sort of cycle going on here with borrowing costs adding to the fiscal problem? Is that a sort of warning for everyone? Quite a lot there. Thank you very much.
Thanks very much, Tim. I'll start with our disclaimer saying we don't get into the details of individual countries, but we'll talk in broad terms on the impact. So, Claudio, over to you.
Okay, there were three parts to the question. The first one was, if I understood correctly, what does it mean? Does a wake-up moment look like? Well, a wake-up moment looks like a sharp adjustment in bond yields that ultimately forces policymakers to focus. Now, that can be quite disruptive, especially because government bond markets, as we know, are the benchmark markets for the pricing of all sorts of assets. And if they're not working smoothly, then the pricing and the working of other markets is not going to be smooth. You mentioned what happened in the UK. That's an example of the things that could happen. United States, well, we know that compared with other countries, and this is something that we emphasize in all of our publications, if you like, the United States is a little bit, so there is a certain US exceptionalism because of the outsized role of the dollar in the global financial system. But that, of course, works both ways. It means that it can take much longer for the specific mechanisms and warning signs to show up. But it does mean that once they show up, the impact on the global economy is bigger. So we need to bear that in mind. On France, nothing really more special to add, except that it's yet another clear case that sovereign debt is, as we have been mentioning, one of the biggest threats going forward, if not the biggest threat going forward in the global economy.
Thank you, Claudio.
Thank you.
Then Alina Bronzati from Agenzia Estado was waiting. Alina.
Hi, good morning. Thanks for having me. Claudio mentioned concerns about the fiscal outlook. In Brazil, the measures to curb public spending were thrown into doubt according to BIS. What are the main fiscal concerns and the BIS recommendations for fiscal policy, particularly in Brazil? What do you think about the package, considering that this situation, the fiscal situation, I mean, is impacting inflation expectations and monetary policy? Thank you.
I'll come back with a disclaimer again on we're not able to comment on individual countries, but I'll hand over to Claudio just to maybe go back in some broad terms on what we're saying.
Sure. I think we talked about France, and now we're just mentioning Brazil is yet another example of the issues that we have highlighted. Clearly, in an emerging market economy with a history of higher inflation, this applies to all such economies. Keeping the fiscal position in order, your house in order, is even more. It's not even more important. It's important everywhere. But the implications of having fiscal doubts about the fiscal sustainability have a bigger impact and tend to occur more quickly than they would in other countries. So that is precisely why it is very important to try and consolidate fiscal position and make sure that there are no doubts about fiscal sustainability.
Thank you very much, Claudio. Chris Giles from the FT.
Thank you very much. I had a question about the chapter on targeted Taylor rules in the quarterly review. The question is quite simple. Given that you show that the targeted Taylor rule relative to the original Taylor rule is very effective in describing what central banks have been doing with monetary policy over recent years, is it the case that you could actually replace central bankers with a targeted Taylor rule?
Hyun, I think, is going to take that one.
Yeah, let me try that, Chris. So what we show is that if you assume that there is a asymmetric Taylor rule, then we can certainly show that the parameter estimates are such that there is this very clear asymmetry. I think in general the monetary policy strategies in practice are a little bit more complicated than simply an asymmetric Taylor rule. But I think what we are seeing through this exercise is that if we actually impose that kind of framework, we do see evidence that indeed central banks do actually practice what they preach in terms of their doctrines, as well as the available theory that's out there. And the theory which go beyond Taylor rules have this feature that of course you should react more to demand-driven inflation than to supply-driven inflation.
Great, thank you very much. Claudio, you want to come in as well? Yeah.
Let me also add that telling in real time whether, 2 points. Telling in real time whether you're facing a demand or a supply shock is not straightforward. In some cases it may be, but in others it isn't, especially if one takes into account the global forces behind commodity prices, for example. Second, that there are issues we're not really addressing, the piece does not really address questions about the optimality overall. It just says that it is consistent with a particular sort of standard theory which is out there. But at the same time, it also warns about the fact that depending on the broader changes in the landscape, the frequency of these shocks, the importance of these shocks, and I would also say the persistence of these shocks, then the way in which you may need to respond would be different. Again, it's a descriptive piece. It is not a normative piece.
Great, thanks very much. So I'd ask if you've a question asked already, please take your hand down, because I think there's some hands, maybe they're going up again. So I'll take it on first questions only. So Martin Arnold, did you want to ask a question as well? And then I can see there's a couple of second questions. Martin.
Yes, please. Yeah, could I ask about R star, the neutral rate, and whether the increase or the perceived increase, because of course it's unmeasurable, whether the perceived increase that the report talks about in R star is related to the higher levels of sovereign debt and growing concerns about the sustainability, perhaps, of some of the high sovereign debt levels around the world. Thank you.
I think both hands are Claudio and Hyun both willing to answer this. So who's going to take it? Hyun. Okay.
Actually, why don't I start and I'll hand it over to Claudio. Actually, Martin, we had a quarterly piece earlier in the year on our star, and in that piece, we laid out some evidence that real interest rates actually have gone up as well, and some measures of our star that build on that, clearly show an increase in the measured R star. Although that's not universal, and I guess if you link the higher real yields to questions about fiscal sustainability, then of course one can draw a link between the discussions we've been having about the greater fiscal risks with the R star measure as well.
Yeah, just to say. I think you were referring to the box more specifically too. And now that box does not take a stand on what are the factors behind it. After all, this is simply what you can deduce from what central banks are saying, particularly the dot plots, and what professional forecasters are implicitly assuming in their forecasts. Fiscal could be one reason why they changed their views. The fact that inflation has been higher and the economies have been particularly resilient, maybe another. But again, these are all, we're just portraying there our views about where R star might be, not about the underlying factors. And we know whose views they are. They are the central bankers and professional forecasters. So maybe by reading what they say, one can get a better sense of what is that is driving their views. Also, I mean, and this is more on a more personal note, as you know, when I said this at a previous press meeting here, that as far as I'm concerned, R star, like beauty, is in the eyes of the beholder.
Thank you very much, Claudio. So looking at kind of new hands raised, I see Li Wei Wang. Li Wei, do you want to ask a question from Shin?
Can you hear me?
Yeah.
So I see in the embargo, towards the end of the executive summary, it talks intensively about the stimulus in China. So I want to ask, China obviously facing this tariff risk, but it's not just China. So many many economists think there will be major impact for inflation and possibly higher terminal rate for global central banks. But the market doesn't seem to be too convinced on this view. I'm wondering what's your thoughts on this? And in terms of a reaction for this, say, first round of tariff, say don't do tit for tat retaliation but rather free trade is the best option. And there are some suggesting, say, currency depreciation is a way to kind of for countries to counter this. And there is another view that for central banks, it would be best to help stimulate domestic demand through measures like lowering interest rate. How do you see for a country or for the global economy the best way to blunt the impact of these tariffs? So these two-part questions. Thanks.
Okay, thanks very much. We lost you a little bit, but I think we got the gist of the question. So again, it's kind of, there's an element of crystal ball or predictions, but let's, I think Hyun, are you okay to take that then?
Yes, thank you. Thank you, Liu Wei. I mean, regarding tariffs, clearly, there are several channels involved in the possible impact on the global economy. One important channel would be how much will tariffs feed through into higher inflation. So that's really a question about what happens to the incidence of tariffs. Is it going to be borne by the importing country, or is it going to be borne by more the exporting, more by the exporters, for example? But I think irrespective of where exactly that number is, this will certainly act as a force for the price pass-through into higher prices, and therefore there will be an inflation knock-on with the implied, a monetary policy response as well. And so if the monetary policy responds to the higher inflation, then that clearly will have an impact on financial conditions and the various configurations of exchange rates as well. From the point of view of the exporter, this will mean that there will be a real economic knock-on, and so they would that will also have an effect on the demand conditions facing the exporter. So I think once we then go through this first round impact, then it becomes much more finely balanced. Then it's to work out the equilibrium responses for the second round, third round effects. So then it's a little bit more uncertain. But clearly, the impact on price pass-through will be probably the most important one there.
Claudio, do you want to add something on the second part of that question about
Sure.
policy response?
Yeah, maybe just one point about the first. I think you may have seen, for example, the recent speech that Philip Lane gave, where he had a very, very long list of caveats about what the impact of higher tariffs might be on, for example, in the euro area, depending on whether the relative impact on demand and the relative impact on prices, the pass-through that Hyun was mentioning. I mean, from a longer term perspective, the point that we have been stressing in the annual economic report, but let me stress that this is from a longer term perspective. The aspect that we find most important is the extent to which the fragmentation or the globalization that we have seen, the integration in the world economy, is going to be reversed or not, and the impact that has on pricing power of labor and firms. Again, we are really talking about the extent to which there may be pressures in one direction or the other, because as Hyun mentioned, ultimately what will happen to inflation will depend on what central banks do. Which goes to your second part of the question, which is about exchange rates and what's the best possible response. Well, obviously, exchange rates, they're relative price of 2 units of account, so not everyone can depreciate at the same time if others respond. So ultimately, I think the best response when it comes particularly for monetary policy, which is going to be the key for the exchange rate at the end of the day, monetary policy has a particular set of objectives. It will have to respond in the line with those objectives, and that will have implications for the configuration of exchange rates and interest rates around the world. But what central banks have to do is to stick to their objective, and in particular to ensure that the price stability rules and prevails.
Thank you very much, Claudio. So I see one other question. I think other hands may be raised for the next set of questions, but I think Naomi Rovnik from Reuters has a second question on the ECB's latest financial stability report, citing risks of dollar liquidity drying up in both lending and FX swap markets. So do we see this as significant, and would further euro weakness against the dollar exacerbate any of these risks? So another speculative question. Claudio first, and then Hyun.
Well, the risks, liquidity drying up as a result of what happens in FX swap markets is something that, as you know, we have been emphasizing for a long time. This is not so much FX swaps as the origin of the disturbances, but as an amplifying mechanism whenever dollar liquidity dries up in particular, and dollar liquidity is key for the global economy. So I think from that perspective, I think it's very useful that the ECB points out to the possible amplification mechanisms that can arise through the dollar. But I'll turn to Hyun, who has very strong views on this too.
I mean, no strong views on this, but you know, the events of March 2020, I think, are still relatively fresh in our minds, and I think what the ECB's report is pointing out is that dollar money markets are extremely important for the functioning of the global financial system, and due to the various amplification mechanisms that could kick in during financial stress. Dollar liquidity and dollar funding markets, would be possibly under stress in those scenarios. The various channels that they operate through a number of different channels. In fact, in our box on the negative swap spread. That's part of a broader set of issues to do with the functioning of money markets, and I think it's best to take this set of issues together as being somewhat related.
Thank you very much. So I'm thinking some of the hands are old hands, but Bastian has signaled that he has a features question. So I'm going to take your hand down if you don't have a new question, and Bastian, over to you on your features question. Thanks.
Thank you again. Yeah, my question is on the housing markets feature. So what I'm wondering about there is essentially the authors are saying that rents, which are obviously an important part of every CPI basket in the world, don't really react to monetary policy, and this to me sounds like a pretty devastating diagnosis of like the potential which central banks have to react to inflation. Am I seeing this too severely, or like how big is the problem in your view? Also, one other question, if I may, to Claudio on a paper which you published last week on inflation targeting. On that, just to get this one right, you are obviously suggesting some changes in the way central banks target inflation. And I'm just wondering, should, in your view, central banks do something different, or should more governments more respect what central banks can and cannot do, if I may add that one? Thank you so much.
Okay, great. Okay, we'll start then with the first question. Hyun, please, on the pass-through to housing markets.
Yes, Bastian. I mean, on your question on rents, I mean, what the feature is saying is the impact on the impact on house prices really depends a lot on the supply elasticity, which I think is very sensible. I mean, if you have an elastic housing supply response, then clearly house prices themselves will be will be less variable because the quantities also adjust. But they're pointing out that rents are much less subject to these these elasticity conditions. I mean, in fact, on your broader question of what are the consequences of rents being less responsive to monetary policy. In fact, we had a bulletin recently exactly on this question, on why rents have been so sticky actually in the recent inflation episode. And there, I think you have to bear in mind both the demand side channel, but also the supply channels, in the sense that to some extent, housing has the attributes of an asset that can give you a yield, and the yield is very much the rent to house price ratio, if you like, and in that setting, when interest rates go up, there is a market mechanisms that tend to equalize those yields, and so perversely, that could mean that rents are somewhat higher relative to house prices as well, if the equilibrium relationship, were to assert itself. And so I think there are several channels through which we can think about this issue. I mean, that channel is not really the focus of the special feature in this issue, but if you look at the previous bulletin that we've put out, we explain the various mechanisms in some detail. Over to Claudio on the second question.
Okay, the second question. Well, this is not really the place to discuss that. But let me just say that in the annual economic report, we do discuss we take a broad perspective on the evolution of monetary policy as well, quite apart from the piece that you were referring to. Some of the conclusions are very similar. I would say that, is it central banks or is it governments? Well, in the first instance, of course, there is significant leeway that central banks have in adjusting the way that they pursue their objectives. Governments can have a role to play to the extent that they obviously influence those objectives, and they have been influencing those objectives over time. But at the end of the day, as is mentioned also there, sometimes it's less a question of the specifics of the objectives. Is it price stability? Is it financial stability? Whatever. But rather of how you actually think the economy works, and the lens through which you see how the economy works, and therefore also what the implications are in the short term, and particularly in the longer term of your actions.
Thank you very much, Claudio. So I see a hand raised from Carlo Boffa from Politico. Carlo.
Hi.
Hi.
Yeah, you can see me now. Apologies, I was late because I misunderstood the time of the meeting. So if you have already answered those questions, please ignore them. I have a question on there is a part on the summary that you've released this morning about terminal rate, and the piece says that basically there is a lot of uncertainty surrounding terminal rate, and that's also due to the communication of the central bank. So I'm asking, wouldn't it be better for central banks to be now many of the major ones have adopted this meeting by meeting approach, the Fed, the ECB, Bank of England. Wouldn't it be better, since everyone in the economic world says that uncertainty is bad, that central bank would be the only pillar of certainty? I mean, without giving the very strong forward guidance that they used to do, but maybe give a bit more certainty. Wouldn't it help the economy? And this is the first question. And the second question, again, maybe about like many of the central banks are having reviews at the moment, and many of them are concentrating on inflation forecasts, inflation expectations, and they are like, some of them, they are even trying to lengthen the period that they look at to have them stable. But I mean, we've seen, for example, in the US election that the economy is booming, but people felt bad about their economic situation. So shouldn't central banks like start looking a little bit more closely at short-term inflation expectations, since that matter more for people? And some researchers even say that they matter more for businesses. Thank you.
Thank you very much, Carlo. I think you've gone a bit outside the quarterly here, but we probably can answer it in some general terms. So, Claudio, over to you.
Okay, more certainty. Well, I mean, you can provide as much certainty as you have. I mean, if you're truly uncertain about where the terminal rate is, I'm not entirely sure whether it would make sense for you to sort of sound more certain than you really are, because then if you're wrong, that's not going to be helpful. But again, that's very much a personal view. But in general, I think that we need to, if you are uncertain, truly uncertain about this, and if there are differences of views, then it's going to be difficult for you to try and paper them over. On the short run versus long-term expectations, clearly both matter, and the extent to which they matter will depend very much on the specific circumstances that you're facing. And I don't think that, I'm not sure whether it would be correct to characterize central banks as necessarily only paying overwhelming attention to long-term expectations at the cost of paying attention to short-term ones, especially when it comes to the possible risks of what we call transitioning from low to high inflation regimes. So I think that the picture is more nuanced than the way that you have portrayed it.
Thank you, Claudio. I see Alina and Li Wei's hands still raised, but I'm wondering, are they new or old hands? So I might just take a pause. They've both gone down. Okay. So, and Carlo,
Sorry.
I see a hand
May I have
raised.
one more
Oh, no,
question?
you have another
Sorry.
question. Okay, Alina, please come in, and then Li Wei, we can come to you if your hand is still raised again. Alina.
Yeah, thank you. About the specific feature highlighted that the greater supply headwinds may force central banks to react more forcefully to supply disturbances to ensure inflation expectations stay firmly anchored. Can you share which countries are more exposed? Is it possible to know which countries?
Just very generally, the countries that are typically more exposed would be those countries in which these commodity prices have a larger weight in the basket, and those countries in which the history of inflation is higher. I mean, I would say those are the two key parameters.
Okay, thank you very much, Alina. I see all hands are now down, that there's no new questions arising. Just take a pause to see if anybody has anything else. Okay, I think we're then at the end. So thank you very much, everybody, for your attention and your time today. At the conclusion of this conference, we want to do a special thank you here as well to Claudio. Oh, hold on. Before the special thanks of Claudio's last press briefing, I see Naomi has a question about high sovereign debt supply in the summer. Is the risk bigger now? We kind of covered that already, but we're going to give a final word to Claudio to answer that before acknowledging your thank you.
So let me just take a slightly, I don't know what now relative to when. If I take a specific horizon, which is when we had a special chapter, a whole chapter in the annual economic report, not this year, but the year before that, on the relationship between monetary policy and fiscal policy. And there we, of course, we paid a lot of attention, and we looked into detail to into the implications of higher government debt and the debt trajectories that we were seeing around the world. If I compare the situation then and the situation now, if we were worried then, there are more reasons to be worried now.
Thank you very much. So with that, we do close the meeting. but before that, we just wanted to say special thanks to Claudio. Claudio has been at the BIS for the last 37 years, and this is his last press briefing. Those of you who've covered us over the years have and keenly tracked all of Claudio's research, pronouncements, etc. He'll certainly be very missed here in the BIS. And he's greatly influenced a lot of thinking in the area of monetary policy, but also financial stability, and also in the economics profession more greatly. So Claudio retires at the end of this year. We look forward to Hyun taking over the mantle and the leadership of the Monetary and Economic Department. So we just wanted to use this opportunity to join us in thanking Claudio for his all that he's given to the BIS and to the wider community over the years. Thank you, Claudio.
Thank you very much. It's been an honor and a privilege, as they say, and they rightly say.
Thank you very much from everybody. So take care, and we'll see you in the new year, everybody.